Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Shares of Lululemon rallying today. The Canadian yoga wear company posted profit and revenue in its latest quarter that topped estimates. Lulu also raised its full-year revenue outlook, and it announced that CEO Calvin McDonald is stepping down at the end of January. Some analysts see that as positive, noting the company has been facing slower sales. Shares of cannabis stocks are seeing a surge after a Washington Post report that the U.S. president will loosen federal restrictions on marijuana. The report says Donald Trump plans to reclassify cannabis as a Schedule III drug, which would be in the same class as prescription painkillers. Shares of Broadcom down despite the chip company reporting sales that surpassed estimates. Investors have questions about how and when the AI investments will pay off. There are also concerns about margins narrowing. Ottawa's new Defence Procurement Agency has awarded Bombardier a contract to provide the Royal Canadian Air Force with 6 aircraft. It's valued at over $700 million. Canada's aging Challenger fleet will be replaced by Bombardier's Global 6500 jets. Having a look at the TSX Composite, it is down today 145 points after 2 record closes this week, sitting right now at 31,515. Across the border, a streak of red, the S&P 500 dropping 84 points or 1.2% on the day. The Dow Jones, a 300-point drop, 0.6%. And the Nasdaq is 426 points down today, 1.8%. Markets declined significantly today. Broadcom leading losses in the tech-focused Nasdaq. Investors responding to lower backlog numbers as part of that story. Let's go to James Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Thanks for coming in.
Thanks for having me.
Why do you think investors are punishing the tech stocks the way they are?
The narrative that it's a bubble and it's over and it's unsustainable is still front and center. People aren't looking at the facts. People aren't looking down the road. So it's shoot first, ask questions later. The Avago or the Broadcom call was fine. It's overreaction. So it's a long-term hold. Let the stock settle out. AI is going to be with us for another 4 to 5 years in terms of the build-out. We're in early days, but we've got to understand that in the sentiment-driven market, you need to quell your emotions and use the volatility as your friend.
Let me ask you a question I asked somebody else earlier. Are investors throwing the baby out with the bathwater?
Yes. We're still early stages. And so, they don't understand what's going on. They don't believe it's sustainable. Look, I was down in New York this week and we had these many conversations. It's going to be a bubble. That's not profound. Railroads were a bubble. We over-allocate capital. The question is, when do we get there? And so what we have on the street right now is that the capital is going to dry up because bull markets or secular bull markets or bubbles, they don't pop because of valuations, they drop of a lack of liquidity. There is not a lack of liquidity, and we're still in the early days. So just stand back, realize that it's a highly sensitive driven market, and use the volatility to buy really good stocks.
Okay. We've had a volatile year between tariffs and AI and everything in between. What is your take on the trading year of 2025?
What I take from it is, again, it was amplified in April with Trump and the Rose Garden ceremony, where people actually thought that those reciprocal tariffs that were used as a negotiation tactic, which is in Chapter 2 of Trump's Art of the Deal, were actually going to stick. And we went down 20%. That is very interesting because we do not get two successive big drawdowns like 18 to 20% unless we have a recession or a financial crisis, which we don't. The interesting thing for me about that is it broke the four-year cycle. So a lot of the folks on Wall Street are going to be telling you about next year is a midterm election cycle year, and we should have a very big drawdown somewhere between January and July. History says it won't happen now. So the four-year cycle's dead. And I would also argue we've got a massive amount of liquidity coming. I think the economic numbers in the United States are going to start to decelerate. And so we're going to see rates go lower than we expect, the Fed's balance sheet to expand, and that's very good for risk assets.
Okay, so you explained about the cycle and essentially the breaking of the cycle at this point. What else are we looking at for 2026? If the AI theme carries on, if there's that extra one big beautiful bill, a rollout, which is expected to give some extra cash to Americans as well, what do you foresee?
Well, when the bill gets rolled out, 100% expensing of CapEx, and that will add about $1 trillion to GDP. So we're going to get what's called supply side policies put in place, which means that they're focused on generating investment growth, which is we lack up here in Canada, and growth that is non-inflationary. Most of the folks I talk to, and when I was down south, they grew up in this Keynesian, everything is demand and all stimulus is inflationary. Trump has pivoted, and he's using a University of Chicago or Robert Mundell, Canadian Nobel Prize winner, supply side. He's going to put policies in that expand the supply side. That makes growth more productive, and it's non-inflationary. So the surprise next year is going to be how rapid inflation drops, and it's also going to be wages in the United States are going to rise because of the immigration policy, which means that the U.S. consumer should go back. You were showing a chart of Lululemon. Mm-hmm. Maybe by the back half of next year, Lululemon really starts to get momentum on fundamentals because of all of this.
Okay. Do a contrast and compare to the Canadian economy and where you see the Canadian economy going in 2026?
Oh, I think we're up here, we're delusional. Listening.
In what way?
Bay Street and the Bank of Canada's response to current economic data, they are looking at the world through rose-colored glasses. The GDP number was weak. The job number was weak. The Canadian economy cannot re-accelerate with 2.25% overnight rates. Those that think President Trump or the Americans' economic policy is a short-term blip that's going to go away are sadly mistaken, need to get up off of Bay Street and fly down to the United States and realize this is generational. And we have a negotiation with the United States coming up where we do not have a strong hand. And so Canada needs to be honest with itself in the situation that we have a weak, not a robust or resilient economy. I am sorry.
Okay. We got to leave it there, James. I'm out of time with you, but thank you for coming in. Appreciate your time.
Thank you.
James Thorne is a chief market strategist, Wellington Altus Private Wealth. Coming up, we'll get back to Lululemon, which beat on profit and revenue for the latest quarter, but also the big news, the CEO stepping down. More in a moment. Shares of Lululemon getting a lift today after the company announced its CEO will step down in the new year. For more, we're joined by BNN Bloomberg with Lindsay Biscaya in the room. All right, so usually it means a big change is coming up when your CEO is leaving, and people seem to be applauding this move.
I know, and this seems like maybe the big change that the company needed. A lot of economists saying that this is time for the company to reset. So Calvin McDonald stepping down after being CEO since 2018. And this retailer has been struggling for quite some time. But as you mentioned, we're seeing that stock today just spiking. It was up 12% earlier this morning, 10% last time I checked. So doing pretty well today. And over the last year, you can see where it sits. So this company's been struggling for a while. The stock has dropped more than 50% over the last year. And the company's seen a slowdown in sales when it comes to U.S. sales in particular, as well as just more competition in general. So yeah, a lot of economists are saying that this is kind of the reset we need. And now the search is on for a new CEO.
Okay. Also, the company did raise its forecast.
It raised its forecast. Yeah. So, I mean, this means the company sees that this could be a good step forward, but also because we're seeing international sales jumping for the company, particularly in China and Canada as well. We've seen sales in Canada ticking up ever so slightly every quarter. But this comes after the company actually cut the fiscal year guidance twice, lowered its sales guidance once. And now the company's saying we're seeing positive steps forward. So expecting net revenue to be between $10 to $11 billion. That's a growth of about 4 to 6%. And that improved guidance driven by international sales, as I mentioned. And the company also expects to be hit not as hard by tariffs as originally thought.
Okay, so we will see what is to come for that company. BNN's Lindsay Biscaya giving us latest there. Thanks for that.
Thanks.
All right, so we got some more perspective from David Schwartz. He's equity analyst at Morningstar Research Services.
Lululemon has had a couple of tough years, and so that often will lead to a CEO change, and that's what we're seeing now. I do think that it's unfortunate that he's leaving in this way, especially with no clear succession plan in place. But sometimes a company needs a change, and Lululemon is in that place right now.
What do you think there's a prospect for a turnaround in this stock? I mean, it's up today, but still, if we look at a one-year chart, still dismal performance over the past 12 months.
Yes, I do. My fair value estimate before yesterday was $295. So I've actually thought it was undervalued at the recent prices. Mm-hmm. There was a time when I thought it was very overvalued when the stock was at its all-time high. But I do think that the decline has been overdone in that Lululemon does have an opportunity to turn around. The company is, despite its problems, the company still has great margins and high growth compared to most other apparel retailers. Most companies would love to have Lululemon's results, but they're only really poor by Lululemon's very high standards of its own past. But Lululemon is still a very strong company, very strong brand with high margins and high international growth. Certainly its growth in North America has slowed considerably, and that's been the main issue. And that was somewhat predictable because Lululemon is a much bigger company than it used to be. Right. And so there just aren't as many opportunities for new stores and for expansion in the U.S. and Canada.
They really are huge. I mean, you have been forecasting revenue of more than $10 billion US this year.
Yeah, this is a much bigger company than it used to be. So obviously it gets harder when you reach that level of size because, every metro area now in the U.S. and Canada has multiple Lululemon stores. And so there just aren't as many growth opportunities there. But Lululemon still has a lot of opportunities internationally. It's opening stores aggressively in China, and the China sales that were reported yesterday were very strong, up 46% in the quarter.
Wow.
And potentially Lululemon could be opening stores in China for many years, because if you look at competitors like Nike and Adidas, they have thousands of stores in China, most of which are franchised. And Lululemon is still small compared to that. And then there's a lot of other areas like in Europe, in many countries in Western Europe, Lululemon only has a small number of stores. So there certainly could be opportunities to open stores there in other parts of the world as well. And then there's also expansion opportunities in terms of product. Lululemon, you just talked about Lululemon's growth in the men's area. It's still smaller than women's, even though we know that men spend more money than women on sportswear. So over time, the men's business could get much larger. Also, footwear remains to be seen if it's going to really work for Lululemon, but it is a big opportunity because really this athletic market is really driven by footwear, and Lululemon only has very small sales in that area. So there's a lot of opportunities still for Lululemon to become a bigger company, even bigger than it is now.
And you think the company could end up this year buying back about $1.1 billion US in stock?
Yeah, Lululemon has an extremely strong balance sheet with no debt and $1 billion in cash. So, and Lululemon generates tremendous cash flow. So the company has plenty of capacity to buy back stock, and announced yesterday that it was increasing its authorized stock buyback by another $1 billion. So, and I do think that stock buybacks are accretive at this price, and so it makes a lot of sense for Lululemon to be buying back stock aggressively. In the past, it perhaps has bought back stock at extreme prices, which maybe was not so great for shareholders. But right now, I think that Lululemon is doing the right thing by aggressively buying back stock.
And of course, Cal McDonald is exiting as CEO after a rough patch, but you say over the years he's achieved tremendous growth in sales?
Well, yeah, Lululemon has had its best years ever since he became the CEO. Maybe that would have happened under a different CEO. That's very possible. But I have to give him a lot of credit because for many years, Lululemon was very successful while he was guiding the company. The last couple of years have become more difficult. The company's had a number of product misses. They've had some merchandising issues where some product got to be too stale, and they've had some issues with sizing and color and things like that. There has been turnover in the design part of Lululemon. They lost their chief designer who went to Vans last year, and that's been a big problem. So that there have been some issues in the last couple of years that led to him leaving the company. But, you know, overall, you have to say he's been a very successful CEO at Lululemon. The company is much bigger now than it was when he came in, and their international expansion is really progressing well.
It's interesting. China is about 18% of their total sales. And as you say, that's a vast market, and they still seem to have momentum there.
Yeah, I mean, potentially Lululemon could be growing in China for many, many years. Yoga is big there. There's growing interest in sportswear in China. For example, marathons in China now become huge. Thousands and thousands of people run marathons in China. All this has really been happening just in the last several years. It's really growing rapidly. And Lululemon is in position to grow there. There isn't as much competition as there is in Europe and North America and China. And so there is a lot of potential there for it to be seen as a luxury brand, just as it is in the United States.
The Randall Koenig is an analyst at Jefferies who has been a long-time skeptic. He's now gone to a hold today. He says, this could point to a change, but he reckons that things could get worse before they get better, that Lulu still has a lot of things to work out. So could this be a bumpy stock to hold for the next while?
The fourth quarter that we're in right now is likely to be kind of a difficult one, and probably there's going to be some slowness into 2026 as well. In my model, I really have the turnaround coming in 2027 and 2028, when Lululemon have a lot of new products on the market, and they will have sold through a lot of the older products that right now they're having to discount to really move. So that will take time. Turnarounds in this industry do not happen overnight. They often will take 2+ years. But I definitely think that Lululemon can do it. The company's brand, I think, is still very popular. And I think that their customers will come back when Lululemon gives them products that they want to buy.
David Schwartz is equity analyst at Morningstar Research Services. Coming up, last call for Canadians to get their share of the $500 million class action in the bread price fixing scheme. More in a moment. It is the last call for Canadians to get their share of the $500 million class action lawsuit that accused George Weston of being part of an industry-wide scheme to fix the price of bread. We got more from CTV's Scott Hurst.
It is your last call to submit a claim for a share of the $500 million bread price-fixing settlement related to the alleged industry-wide price-fixing of packaged bread. So let's walk through the details of what you need to know, what viewers need to know to be able to take part. Anybody in Canada, adults in Canada, can apply. Canadian residents, no proof of purchase is necessary. So no stress trying to find an old grocery receipt. You're eligible if you bought packaged bread for personal use between 2001 and 2021. You just need to file an online claim. There's a separate claim process for Quebec residents. Now, as you pointed out, this stems from the class action lawsuit that accuses Loblaw and its parent company of engaging in an industry-wide scheme to fix the price of bread. The suit alleged that the companies and other big players in the industry engaged in these practices from 2001 for several years, ultimately, Andrew, impacting the price that we paid.
And then what comes next? Is there any timeline on how much money we'll get?
At this point, you can expect to receive compensation within 6 to 12 months, so the money should be in your account at some point in 2026. Payment, according to the website where you file the claim, will be made by Interac e-transfer or, if requested, by check, and the amount of compensation will ultimately depend on the number of claims. And so the other question, what comes next from a legal perspective? The law firm at the center of the class action says it is still pushing for more accountability. I believe we have a clip from that law firm to play.
We've been litigating for 8 years. It's been very difficult. It's an expensive, protracted, slow process. But we did our best to hold Loblaw's feet to the fire. But to their credit, they came to the table. But the most important thing, in addition to the money, the other really important feature is that we're going to be getting information from Loblaw's in Q1 next year, which we hope will, let's just say, bolster our cases against the other alleged co-conspirators.
Other major Canadian grocers, including Metro, Sobeys, Walmart, Canada Bread, and Giant Tiger, were also accused of price fixing during the time frame of the suit, Andrew. They have all denied involvement. But bottom line, for residents, people like you and me who bought bread over the last 20 years, the deadline is today to be part of this class action lawsuit settlement.
CTV's Scott Hurst with the latest there. A quick look at the markets before the end of the trading day and the end of the trading week. The TSX had 2 record closes this week, but today has dropped 139 points so far. The S&P 500 also down today by 77 points, so over 1%. And the NASDAQ, a 415-point drop, or 1.75%. The closing bells coming up next. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ, Serve Robotics ringing the closing bell. In New York, for the New York Stock Exchange, executives and guests of Madison Square Garden Entertainment and the Harlem Globetrotters celebrating the 100th anniversary of the Harlem Globetrotters. We're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. A down day for North American markets, with the TSX dropping 133 points today. It had 2 record closes for Wednesday, Thursday, but dropped today to 31,527. Let's move south of the border, where there is another streak of red. The S&P 500 dropping 73 points today, just over 1%. The Dow Jones, a 246-point drop, or about 0.5%, and the NASDAQ, a 398-point drop, or 1.7% down. Let's get to the movers in Toronto. Curaleaf, which is a cannabis company, gaining an unbelievable 37%. It was up over 45% at one point today, on reports that cannabis could be reclassified in the U.S. Stephanie Hughes has more on that storyline in just a moment. Let's get to Parex Resources, which climbed over 4% today, a gain of 71 cents. Taking that stock to $18.01. CAE, which does flight simulation, that stock gained more than 5%, about 5.4%. So it's up 23% on the year, a gain of $2.10 today. And then Celestica taking a big hit. It is down 7.8%, about 7.9 actually, losing $1.71. Still up over the year, 121 dollars there. So Celestica down today. Also, Energy Fuels a dropper today. Company Insider sold almost $1 million worth of shares there. So that is what hit Energy Fuels. It dropped 7.8%. First Majestic Silver is down today as well. It dropped over 5%, or $1.23. The stock ended the day at $21.92. All right, let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with more on the movers. Stephanie, let's start with Curaleaf. It's been bouncing around a lot lately, but really took off today. Give us the backdrop here.
Sure thing, Marilla. Yeah, so anybody following the news about President Donald Trump potentially easing the regulations around cannabis probably wouldn't be surprised to see Curaleaf, a cannabis company, being the top TSX performer today by a pretty big margin, too. So specifically, it rose by as much as 50% at its peak today. That's a pretty sizable spike upwards. In fact, it brought the share price to its highest level since last July. As well, another interesting detail is that this move today marked its biggest intraday move since October 2018, when recreational cannabis was legalized in Canada. And I'm not trying to be funny here. I'm not trying to, there's no typo, but that did send the stock up by over 4,200%. That gave me a chuckle when I saw that on the terminal today. So in the U.S., cannabis is currently labeled as a Schedule I drug, putting it in the same category as substances like heroin or LSD. According to sources, Trump is considering reclassifying it as a Schedule III drug, which would put it in the same category as ketamine or Tylenol with codeine. So that is pushing, that would obviously open up the recreational market, and that's helping a few cannabis names grind higher today, like Tilray, Canopy Growth, and of course, Curaleaf, Marilla.
All right, let's get to a new order for Bombardier. Sent shares up for the aerospace company.
That's right. Yeah, those shares moved by over 4% higher today, and that at times put Bombardier, the plane maker, above or among the top performers on the TSX today. So that came after the Royal Canadian Air Force ordered 6 of the plane maker's Global 6500 aircraft in a deal valued at around $753 million. These jets will replace the current CC-144 Challenger fleet, and they will aid in global support missions and humanitarian missions like evacuations and disaster relief. That first delivery is expected in the summer of 2027, and a lot of this is made possible by boosted military spending. Canada's federal budget pledged billions of dollars over the next 5 years into Canada's military. So we're seeing that play out in deals today, this deal today, deals just in general, and in the share price for Bombardier, Marilla.
All right, Bloomberg's Stephanie Hughes with the latest movers in Toronto. Thanks for that. Have a good weekend. Let's take a look at the Celestica chart just before we head to a quick break, because it was one of the movers in Toronto today, and it dropped 12.92%, almost 13%, a loss of $62.60 per share, taking that stock to $421.77. When we come back, a closer look at the markets. As you can see, the AI pessimism still continuing to wash through. Back in a moment. Broadcom getting punished today as AI investors still wonder about what lies ahead and whether all that CapEx spending for some of the big tech is going to deliver dollars to them. My next guest notes that every CapEx cycle does eventually turn to tears. Let's get more from Marco Papich, Chief Strategist at BCA Research. Thanks for joining us today.
Absolutely. Thank you for having me, Marilla.
So I'm sure some are already crying watching these stocks. What's your read on where we are in the AI cycle?
You know, it would be very curious that it ended only 18 months after it started. So history is very clear on this. Every single capital investment cycle throughout history has always ended in tears. We just can't, as human beings, we just can't stop building too much of what's new. So from the canals to the telegraph to the phone to everything else, this has always happened. That said, this particular cycle started only 18 months ago. So I don't think that the end of the CapEx cycle is going to end in 26. The problem, however, is that we haven't really had any news flow on the AI front that's really profound. You know, nothing has really compelled us to download a new app over the last 12 months. And so investors are going to want something like that in the first or second quarter of 26 in order to justify all this data center buildup.
Okay. Do you feel like right now it's the process of picking winners and losers, or are we not even there yet?
I don't think we're there at all. First of all these LLMs look relatively the same. There's fear that they're going to end up being internet browsers, which, of course, as you know, because you use one every day, you don't pay for one. So there's a lot of questions that are still being asked. And I think that the data center build out is, people are starting to scratch the surface on how many of these are financed. At the beginning, it seemed like the hyperscalers were just dipping into their cash hoard and investing that into data centers. That's no longer really the case. There's a lot of issuance, a lot of debt issuance. It's, in fact, potentially even crowding out some of the treasury issuance in 2026. There's private credit involved, private equity firms, all sorts of nexus of circular financing that's causing a lot of investors to ask, am I the last dollar in the data centers trade? So again, I think the proof is going to be in the pudding. And what I mean by that is that there needs to be more news flow on the AI utility front. And so that's why we're watching the adoption across enterprises. We're also watching whether businesses actually start seeing productivity enhancement. And the data so far is inconclusive.
Okay, so do you think next year then will be more of the same, where investors are looking for how this is paying off, how the investment paying off, and expect to see that more clearly next year?
Over the course of 12 months, yes. But I think Q1 is going to be very tough. You have a lot of things that bothered us in 25, whether it's tariffs, whether it's geopolitics, whether it's fiscal policy and bond market reaction to it. A lot of those things were answered in a very bullish way, but they were answered like 3 months ago. So all the good news is already done. So I think Q1 is going to be tough, no matter how you look at it. There's new questions now being asked, which is, why is the 10-year yield stuck at 4.1%? That's not good for equities. That's not good for consumers who could be re-leveraged if borrowing rates come down. The second question is CapEx in the data centers. Is it necessary? Do we need all these data centers? And right now, I don't think we have answers to that. So I think that the stock market probably needs to go down significantly in Q1, not because of a recession, just because we don't have answers to these questions. And then those questions are likely to start being answered Q2, Q3. So what I would tell investors right now, don't get overall too bearish on the year, but I do think Q1 is going to be tough.
Okay, you're bullish on Europe for 2026. Why is that?
Well, I'm bullish because I think that all the answers are going to be given by May. Why May? What's curiously going to happen in May? We're going to have a new Fed chair. And the new Fed chair is going to drive monetary policy of the United States of America into a definite dovish direction. Right now, everybody in the market is pretending that Kevin Hassett is somehow too dovish, that he will careen central bank independence off the rails. I think that's weird. I think that's unfair to Kevin Hassett. He worked for very centrist presidents or presidential candidates on the Republican side, so he's not unorthodox. But the market has decided that it wants a certainty on who the next Fed chair will be. I think ultimately by May, after a little bit of a sell-off into Q1, everyone will be desperate for that dove. I think that dove will come. And so my message to investors is, you don't want to fight the Trump in 2026. Monetary policy will be dovish. And I think that the United States will probably have interest rates 50 basis points lower than it should. And that will be amazing for stocks. The problem, particularly for Canadian investors, is that on a currency-adjusted basis, S&P 500 may not look great. So I think that we will have another run of non-US outperformance. And so if I was domiciled in Canada with a CAD as my reference currency, I would start really thinking about how much exposure I want to the S&P 500, because S&P 500 could easily go up, 8 to 15% next year. But if the US dollar is down 10%, then you probably should have been in Europe, in Japan, in China, and in Canadian stocks as well.
Okay, let me ask you about sectors beyond tech, which is where we started the conversation. In North America, what are the other sectors you are liking for 2026?
So one of the reasons that I'm bullish on the economy, with some reservation, but I think that President Trump and Treasury Secretary Scott Bessent are going to focus on really reviving the consumer. And American household is not levered, so they can re-lever. And that's one of the reasons why I think monetary policy will be quite dovish, to suppress borrowing rates and to restart some sort of a housing cycle. So what I'm bullish on the sectoral basis, I think that housing and consumer discretionary can actually have a pretty good recovery in the second half of the year if borrowing rates do come down. I also do like commodities, energy as well. I think oil prices could have quite a nice recovery. This is one of the reasons, not the main one, but one that I would be bullish on the Canadian dollar and also just Canadian economy in general. I think there will be a recovery. I think oil prices can finally find a bottom also in the second half of the next year. And on the commodity front, I think as the rest of the world realizes that the U.S. can no longer fiscally stimulate as easily as it did in the past, I think commodities are likely to do well for two reasons. One, dollar decline is good for commodities. But second, how do you offset decline in American aggregate demand? If you're China, Europe, Canada, or Australia, you're probably going to build some ports, build some roads, repair some warehouses. And so you should see global capex continue throughout the next 12 months.
All right. I got to leave it there, Marco. I'm out of time, but appreciate your time. Marco Papich, Chief Strategist, BCA Research. When we come back, we're watching cannabis stocks today after the expectation or reports that the U.S. president will reclassify marijuana as a less dangerous drug. More in a moment. Tilray and Canopy, both cannabis stocks, up today after a report in the U.S. that Donald Trump could reclassify marijuana as a less dangerous drug. Here to talk about that is Dan Ahrens, Managing Director of Advisor Shares. Thanks for joining us today.
Hey, thanks for having me on.
So this has been widely anticipated, of course, but what does a federal reclassification do for these companies when they want to borrow money, for example?
That's just one of the many aspects that comes into play. It's a very, very big change for the United States and cannabis at a federal level. It's very different than Canada, for instance. And what they're talking about doing, and it's been talked about for a few years now, is reclassifying cannabis from a DEA Schedule I drug, which has no medical use, and it's usually used for dangerous opioids and other drugs, down to a Schedule III drug, which typically is a prescription type of medication. But there's a lot more ramifications here. Cannabis companies, plant-touching THC businesses in the United States, can't do regular banking. And tied into that is these stocks can't be custodied or traded at major bank wirehouses, all the major brokerage firms like Merrill Lynch, Bank of America, JP Morgan, Morgan Stanley, BNY Mellon, and many others, and can't list on major exchanges. So there's an awful lot of ramifications that come down from this rescheduling that we're now finally expecting. So I see not only today's big stock market moves, but multiple legs up as this goes through the process.
Okay, you talked about the stock being able to trade. You talked about money borrowing. What about tax implications?
Great question. Thank you. These cannabis companies in the United States are subject to something called 280E taxes. What that means is they're basically taxed like narcotics traffickers. They can't deduct any business expenses. Now, when this announcement that we expect perhaps as early as Monday, through an executive order from President Donald Trump, comes down, we don't know what all the details look like. Is it going to have safe harbor in there for exchange listing, for banking? And what is the timeline for removing these very unfair 280E taxes where these businesses can't deduct any business expenses at all? So when we get that removed, and it definitely will get removed if this is now a Schedule III drug, it has a huge impact on these U.S. cannabis companies' bottom line.
Okay. There are also state-level regulations for cannabis companies. So how does a federal reclassification affect what happens at the state level?
Well, we don't know what everything looks like quite yet, but what happens here is, we have close to 40 states that have medical cannabis, and this rescheduling will very easily allow medical use cannabis nationwide. Now, we also expect guidance from the Department of Justice, from Attorney General Pam Bondi, perhaps, that will support states' rights. And what I mean there are, we have almost half the states in the United States that now have adult use cannabis legalized. And what's going to happen is, with this federal guidance, we should see that they will defer to states' rights, and individual states can allow for adult use cannabis, very importantly, without it being contrary to federal law like it is right now. Right now, the federal government is primarily just willing to look the other way, but these companies are still contrary to federal law and therefore can't bank, can't be custodied at most major brokerages, can't be listed on major exchanges, etc. So we're still going to have a state-by-state regulatory regime. And for people with questions about that, they don't need to look a lot farther than the alcohol industry. There are different state laws for alcohol all over the United States, and different cities and counties and others.
Okay, one last question for you. And how do investors take advantage of this reclassification? What can they look at? Have they missed the boat today?
I don't think anybody's missed the boat because we haven't had an official announcement from the White House yet. It could come as early as Monday, perhaps at some other time next week, or certainly before the end of the year, we expect. But today's big move was just based on a Washington Post article that comes from very, very good sources and has very good backup. But we don't have the official announcement yet. So I think there's going to be multiple legs up. Here at Advisor Shares, we manage the largest cannabis fund in the world, the MSOS U.S. Cannabis ETF. And we also have another one that has a global strategy that includes the Canadian stocks, even UK stocks and Israeli stocks. So one fund that's all about the U.S. only, and one fund that is a global cannabis strategy.
All right, Dan Aarons, I got to leave it there. So thanks for your time. Appreciate it.
Thank you.
Up next, we've been watching shares of Broadcom today. That company warned growing sales of lower margin custom AI processors have been squeezing profitability. More in a moment. Here are the stories we are following today. Oracle shares closing lower after reporting that they will be pushing back the completion dates of major AI projects. AI centers for OpenAI won't be ready until 2028. That's a year later than expected. And Oracle also just reported earnings and missed the mark on key metrics, fueling more AI uncertainty as we head into 2026. NASDAQ proposing a new rule that would allow the exchange to block IPOs even when companies meet all listing standards, if it detects red flags that could make a company's stock vulnerable to being manipulated. The move underscores a push to tighten gatekeeping as firms from hazy jurisdictions look to tap public markets in the U.S., where a deeper pool of capital often gives companies better valuations than they can get elsewhere. Athabasca Oil was one of the biggest decliners today on the TSX after providing a 2026 production outlook that disappointed investors. The Canadian oil and gas producer expects average production next year of up to 39,000 barrels of oil a day, which fell short of analysts' estimates. Athabasca has also earmarked $273 million for its thermal oil division and will lower the capital spending budget at Duvernay. Our next guest views today's decline in Broadcom shares as a buying opportunity for investors and has raised his price target on the stock. We spoke with William Kerwin, senior equity analyst at Morningstar Research.
Broadcom's role is in AI semiconductors, and they are in part a competitor to NVIDIA and in part a complementary player to NVIDIA. So
Right.
what Broadcom produces are what we call custom AI XPUs versus a generalized solution like a GPU from NVIDIA. These are customized chips tailored to a specific application or a specific customer. So Google is a common example. Their TPU is customized to their internal workloads like Google Search and training the Google Gemini model. So they have 5 marquee customers in this business, and they make chips customized to each of those customers. Now, in addition to those compute chips, they also make connectivity chips, what we call networking, and they supply those across the board to really every AI customer you can imagine. But the focus of the call and the share reaction today is really in that XPU business.
And does it look like they have slowing momentum there?
Not in the slightest, in our view. We loved the results last night, and we are increasingly bullish on the name. Rather than any slowdown in this demand, we are seeing an acceleration in Broadcom's demand through the course of fiscal 2026, and we think into fiscal 2027. And there are 3 primary drivers of this. So one is their existing customers are seeing rising demand, and Google is chief among these. There's been a lot of bullish narrative in the market over the past month on the latest TPU for Google. This is a version of an XPU, which trained their Gemini 3 model and is now actually being rented out by competitors like Meta and like Anthropic because it's so strong. So that existing customer demand is rising. We're also seeing a layering in of new customers like Anthropic and like a 5th unnamed customer that was announced last night, adding to a really what we expect to be a surge in second half of 2026 revenue. So far from slowing down, it is accelerating.
Why are investors worried then, William? Is it simply because they're nervous with the huge run-up in the stock for, I think it's 3 years now?
That's probably the background to all of this. There were some nitpicks you could make on the call, so to speak. So these custom XPUs are actually gross margin dilutive, and we think that may have spooked investors a little bit. But we don't worry about that because even if they're gross margin dilutive, the amount of volume that Broadcom is able to sell of these makes them operating margin accretive and earnings accretive. Now, you had mentioned the backlog at the outset of this segment. That was a concern, too, because we think that investors are comparing that to NVIDIA's $500 billion backlog, and Broadcom's, in relative speak, was a measly $73 billion. But these are apples and oranges in our view. The $73 billion number that Broadcom threw out was actually higher than we were estimating, and we think there will be upside there because that was a number given for the next 18 months. We expect new orders to come in over that time. These are generally short lead times, and so we actually see that as a bit of a floor for what they can do over that period.
And what about their balance sheet? Have they racked up lots of debt like Oracle?
Not to the extent that Oracle has. Now, Broadcom is a serial acquirer, and 2 years ago, you may remember the massive VMware acquisition that the company conducted. They took out a significant amount of debt following that acquisition and are continuing to pay it down. But simply put, this company is a prolific generator of cash flow, and quickly, even only a year to 18 months out from closing that acquisition, we think they've successfully delevered less than 2 times leverage now, and they are printing $40 billion in cash flow by our forecast over the coming year. So we don't worry about the balance sheet at all. We think it's in pristine shape.
What about generally AI? I mean, it's a very broad question, but do you think there's going to be tears ahead and broken dreams in these stocks? Do you think that the whole sector over the next few months is going to be under pressure?
It's all about expectation setting. We really believe that AI is a long-term trend that will benefit this AI infrastructure and tech hardware over the long term. Now, that is not to say that that's going to be a linear progression up and to the right. And so I do expect there to be fits and starts during this demand. But in the short term, meaning the next 1 to 2 years, everything is highly supply constrained in this environment. And that can be viewed as a negative because the likes of NVIDIA, the likes of other AI infrastructure hardware players could be shipping more today based purely on the demand, but they're being constrained by the supply. But that can also be viewed as a good thing because what that means is that many orders for these chip makers or other infrastructure players are already booked through the course of the next 12 months. And that provides some nice certainty in the market that this revenue is going to manifest. Now, at some point, potentially in the next 3 to 5 years over that medium-term period, we would expect there to potentially be a correction or a normalization or maybe a slowdown in this demand. But we would view that as a short-term, bumpy dynamic over the course towards this long-term positive growth that we expect.
William, we better leave it there. Just remind us, though, one last thing. I mean, is there still an iceberg for AI investors? I'm wondering about these reports we've seen. And of course, it's such early days that corporate customers are not realizing the extra revenue and or savings that they hope for from AI investments.
Well, that is the trillion-dollar question. We think, at very least, in the next 1 to 3 years, there's enough investor appetite from the investors in the spenders on AI to continue spending in the hopes that that revenue and those cost savings come out. And if that doesn't happen in the next 3 years, then we may be having a different conversation. But we believe it'll come. It may take longer than investors currently want. And that's what I was talking about with that potential for a correction or normalization at some point down the line in the next 5 years.
William Kerwin, Senior Equity Analyst, Morningstar Research. Up next, time of the year where you will have to think about taxes, what deadlines need to be met, and how you can plan effectively. That's coming up next. We're at the end of the year, so a lot to unpack with year-end tax planning. Did a few deadlines by December 31st. For more, we were joined by Jamie Gollenbeck, Tax and Estate Planning Managing Director, CIBC Private Wealth.
Well, we always talk about, the end of the year tax loss selling. You have a deadline of December 30th that settle that trade by December 31st. And you would do this, you have, the odd loser in the portfolio. You don't think it's going to bounce back, and you want to be able to use that capital loss against any other gains this year. But it's also your last kick at the can to go back 3 years. So you can take capital loss, apply it against capital gains in the prior 3 calendar years. And so 2022 falls off the table. So I would just take a quick peek at your 2022 tax return. If you reported any capital gains there, maybe now you want to realize that loser before the end of the year, take that loss, carry it back to 2022, and get back any capital gains tax paid in that year.
And how many do you sell? What do you base that decision on when you're looking at your loss at the investments that aren't doing well? Do you hold on to some? Or how do you make that decision?
Yeah, so I think primarily you want to make sure it's an investment decision. In other words, you don't want the tax to drive it. At the same time, tax could be a consideration. So I'd look at your portfolio and say, these particular stocks, these positions, I think I'm done. I think I could better deploy these assets somewhere else in a different stock or a different position. I can rebalance the portfolio, time to take those losses. In terms of the quantity and quantum of those losses, then you really want to be strategic. Do I have other gains this year, in which case I can get the capital gains tax eliminated? Do I have gains in the prior 3 calendar years? Otherwise, you don't have to sell anything else because losses carry forward indefinitely. So there's no rush to sell things from a tax perspective if you can't use the loss right away. But at the end of the day, I would say make an investment decision first. That should be your primary consideration.
Okay.
Jamie, for some investors, you talk, for high net worth individuals, stuff like that, the idea of, personal holding corporations or things like that are better to hold investments. And what are you thinking as should it be as an individual, or are there any reason to, put it in trust or do other forms that are, better defer the gains over a period of time or a better way to take in income as well?
Yeah, well, it's interesting. So there's a number of planning opportunities out there. I mean, the truth is that, if I was setting up a corporation today purely for investment, I probably wouldn't do it because actually investment income is taxed poorly in a corporation in all provinces. The tax rate is effectively higher. But most people, of course, have a business. or they have a professional corporation. The money's already in a corporation, in which case it's expensive to take it out. So they do their investing in a corporation. There are some other strategies out there. People have used family trust, for example, on the high net worth side to do some income splitting. You've got to be careful. There's attribution rules there. One of the more popular techniques that we've been promoting over the last number of years with the decline in interest rates is to do what's called a prescribed rate loan, where let's say a parent loans funds to a family trust, charge the minimum 3% rate. Any rate of return above that can then be taxable out to the beneficiaries. Typically, these would be children and other family members. So there are some more sophisticated strategies out there involving family trust. But, for the average person, investing in a non-registered portfolio to the extent you use up all of your RSP and TFSA room is probably the way to go in a basic non-registered trading account.
All right, and let's talk a little bit about TFSAs. What's the best way to approach those if you've got some room or you might want some money from it?
Yeah, so again, one of the things we're telling people is between now and the end of the year, if you think that you need to tap into your TFSA for any reason, because TFSAs are a general purpose investment account that you can use for anything from a new car to a new roof or an emergency fund. The nice thing is that if you need money, let's say earlier next year, take it out this year. And the reason we suggest that is because you're allowed to recontribute any withdrawals beginning the following calendar year. So let's say you need to take $10,000 out in February for some reason. Take it out in December, because if you take it out in December, I'll have it for February. But then should you have some extra cash anytime in 2026, you'll be able to recontribute it immediately back to the TFSA. If on the other hand, you wait till February when you actually need the money and you take the $10,000 out, you're not allowed to recontribute that until the following calendar year, 2027.
I have another one, Jamie, more as a personal thing, because I turned 70 in January, and I have to roll out of my RSP. Do you suggest most people sort of go into RIF the same way, or annuities, or what are the options? Because I guess if you take it all out, it's all taxable at that point.
Well, that's right. So you have to convert your RSP by the end of the year that you turn 71. And you've got three options. Of course, you can cash it in and pay tax, which no one wants to do. I think rarely do people take that option. The most common option is the RIF. The RIF is a continuation of the RSP, but it's in reverse. A RIF requires you to take out a minimum amount, starting at around 5%, going all the way up to 20%, depending on your age, of the fair value every single year. There's also another option, a registered annuity. Some people do both. They want a guaranteed flow of income, so they'll put part of that money into a registered annuity. But I'd say most of our clients want the flexibility that comes with the RIF that allows them to choose the investments inside that account and then take out the minimum. Of course, you could take out more than the minimum, but the minimum amount every single year. And of course, you pay tax on that on an annual basis starting after age 71.
Okay, we're going to go the other way because I'm a young student, unlike John. And let's talk about what should we be aware of for the end of the year for students?
Yeah, so a couple of things. Students, we often recommend the RESP, the Registered Education Savings Plan. Parents want to make sure, grandparents that are topping up $2,500 a year for every single student to get the Canada Education 20% match. That's $500 per year per child in RESP. But I would also say before the end of the year, if the students are already in post-secondary education, you might want to be strategic about RESP withdrawals. The withdrawals, other than the contributions, are taxable to the student. But remember, each student, each individual in Canada gets a basic personal amount, which is over $16,000. So this is an opportunity to withdraw $16,000 of educational assistance payments per student each year to soak up that basic tax credit. So if someone has no other source of income, they don't have a lot of income from either a summer job or a part-time job, in the next couple of weeks of the year, take a look at the student's projected 2025 income, see if there's an opportunity to take out extra money from the RESP that'll help pay for some of their post-secondary education expenses this year.
Jamie Gollenbeck, Tax and Estate Planning Managing Director, CIBC Private Wealth. Coming up, from Pop Mart's Labubus to Shein and Temu, the growing power of Chinese brands when we come back. From Pop Mart's Labubus to Shein and Temu, Chinese brands have become global consumer favorites and cultural ambassadors. With much of the credit going to TikTok, shoppers are hungry for more. Bloomberg's weekly doc explores the growing power.
Shoes, phones, windows to alternate realities. Many of our favorite products are made in China, but designed elsewhere. Well, that narrative's beginning to change a bit.
Pop Mart shares rise to a record as the CEO announces a new mini Labubu.
And the Game Award goes to Black Myth Wukong.
What we're seeing now is an emergence of Chinese soft power into the rest of the world.
In the past, China was creating all these low-value products, and it's very hard to gain soft power from that. But as you move up the value chain, the natural byproduct is that your soft power also increases.
We will continue to actually see more of them penetrating into various overseas markets.
As the power of China in the global economy has increased, it's an opportunity for them to go and invest in these other markets, similar to the way that American companies probably did in post-war America.
Although no one's saying that's going to be smooth sailing.
A lot of the challenges for Chinese brands, especially in the US, depends a lot on the political uncertainties that have been unfolding under Donald Trump.
Some are locked out of whole markets, while others have invited a certain kind of rhetoric.
The Chinese government has that data.
So with Chinese brands seeming to win over global consumers, could they also help with something much less tangible? Soft power doesn't get much softer than these furry little enigmas. All right, calm down. These things, they're changing perceptions, one screaming child at a time.
You've got people across the world, across the US, on TikTok, unboxing their Labubus, showing off their hauls, from everyday buyer to a major celebrity like Lisa.
Riding that wave of hype has paid off for the brand behind the world's favourite new furry merchandise.
Pop Mart had one store when it opened in Beijing about a decade ago. It's now been able to open across the US, not just on the coast, but in areas of the US heartland like Ohio, and that shows just how far its reach has gone.
Since 2024, Pop Mart's annual revenue has more than tripled.
The overall sales grew as much as 250%.
Addressed the thank you card to TikTok, one of China's other major cultural exports.
TikTok is a really popular app in the US, and it now ranks among the top 5 social media apps, alongside the likes of YouTube, Instagram, Facebook.
The app has over 1 billion users worldwide, including over 170 million per month in the US alone.
And it really brought in a whole generation of young Americans and introduced them to a Chinese brand probably for the first time.
This is a crowd that loves to exclusively browse and buy online, a habit that's already second nature to most Chinese consumers. This chart shows the percentage of people who use apps to shop online and make in-store payments. Compared to the US, for instance, where about 40% of all retail payments are made using phones, Chinese consumers are far ahead.
There has been a generation of Chinese companies that came of age during this mobile-first e-commerce era.
Chinese companies have really had this advantage at home of being able to hone those strategies on these consumers.
And now Chinese companies are bringing that to your morning caffeine.
Luckin became China's biggest coffee brand in 2023, surpassing Starbucks for the first time.
That's in terms of sales revenue, and since then, its lead has only grown. But it's also true in terms of store numbers. As of October 2024, Luckin had 3 times as many stores in China as Starbucks.
In China, it offers drinks for as little as $1, and it's really forced Starbucks to rethink its playbook in the country.
For instance, Luckin customers can only order through a mobile app. That keeps staff and costs down.
And now Luckin's really bringing that fight to the US. It's opened a number of locations in New York, and it's introduced a few items for its fall menu that have pumpkin spice in them. Luckin Coffee is a great example of Chinese companies not only bringing their playbooks to the US, but now starting to adjust what they're doing to accommodate US tastes.
Another place ripe for expansion is here.
Brazil is very similar to China in the sense that we are seeing growing urban centers.
They also had a shift in their demographic to more middle class, so higher ability to spend.
And more importantly, a good part of that population are a lot younger and more willing to actually embrace some of these digital tools into their daily lives.
The retail apps are some of the largest and most popular now in Brazil, specifically Temu and Shein.
And more are looking to join the party.
Meituan, the food delivery business, planning to spend $1 billion over the next 5 years to launch Meituan in Brazil.
This came just as President Lula was visiting Beijing and signed a deal to allow more Chinese investment in mining, transport, and ports. You'll find this mix of government backing and business expansion in other places too.
There is a government push. They have the backing of Beijing to actually go overseas because China would also like to build its global footprint through its companies.
In part, that's because of pressure at home.
China has been going through factory deflation. These companies are facing downward pressure on prices because of intense competition. In order to survive in China, they have to go overseas because that's where they can charge higher prices, get higher profit margins. One of the biggest challenges that Chinese brands are facing now is, of course, the geopolitical uncertainties. We're talking about tariffs, investigations going on into certain sectors.
There is increased scrutiny on data privacy.
Take Huawei, for example. It was blocked from the US over national security concerns. TikTok's faced similar scrutiny, although there has been some softening there.
I like TikTok. That's why they're saying, are you saving? And we probably will save TikTok.
Keep TikTok!
Efforts to save TikTok is evidence of just how entrenched Chinese brands have become, and this familiarity could be shaping people's views. TikTok is popular in youth culture, and a Pew Research Center survey found that people aged 18 to 34 tend to view China more favorably than 35 to 49-year-olds, or the 50-plus crowd.
For an average user, I don't think they see it as a Chinese app or a Chinese retailer. They just think of it as an app.
And that's arguably what soft power is all about. It's meant to be nebulous and unidentifiable. But even if it is working, it's a long road. That same Pew Research data shows most of the countries surveyed still have broadly negative perceptions of China. So the longevity of Chinese brands may depend more on good business strategy than politics.
There are also a lot of questions about sustainability and whether a company like PopMart that's been able to grow this rapidly is going to be able to carry that forward, or whether it's something that's going to see a bubble that will burst.
Retention has become a big issue for Shein and Temu. Amazon has 93% retained user rate in the US. Temu is like in the 60% range. So people are pivoting on and off their app.
Despite challenges, Chinese brands are probably here to stay, and this adds to the nation's growing global prominence.
We will continue to actually see a world that is incorporating more Chinese products as well as Chinese-backed services into their daily lives and into their work, with or without them knowing it.
It's a natural transition of the Chinese economy that eventually leads to the cultivation of the soft power as well.
All right, that does it for today's program. Thanks for joining us today on The Close. Have a great weekend. We'll see you back here on Monday.